Types of deals and internal approval process. In this video, we will explore the types of deals supported by deal management, the incentive categories in those deals, as well as an overview of the approval process. Let's get started. In general, there are 4 types of deals in the core business: issuing deals, merchant deals, other customer investments, and acquiring deals. Issuing deals are agreements with rebates or incentives paid out of issuing revenue margin. Issuers have traditionally been banks, but now include fintechs and others, such as self-issuing merchants, who issue cards to consumers or businesses. They issue a variety of MasterCard branded products, including consumer credit, consumer debit, prepaid, and commercial, in both single or multiple currencies, and with physical plastics and/or virtual accounts. Issuers pay standard fees to MasterCard, known as rack rate pricing. In exchange for commitments they make to MasterCard, issuers can receive rebates and incentives through a Customer Business Agreement, or CBA. CBAs are customized to individual issuers dependent upon the specific MasterCard products to be issued under the agreement, as well as commitments on exclusivity and performance. The objectives of a CBA are to promote MasterCard branded products, drive card spend and market share growth by providing the appropriate targeted incentives that drive the desired outcomes. Merchant deals refer to commercial agreements with shops and merchant establishments to whom funding support is provided to drive MasterCard brand awareness, card acceptance, card usage, and spend. Merchant deals are more selective and strategic, generally with funding provided for specific purposes or targets. An example of a merchant deal is a one-time fixed support payment to a strategic merchant for offers available only for MasterCard branded cards. The purpose is to drive consumer preference over other networks and thereby drive MasterCard spend volumes. Other customer investments are typically small incentives of less than $1 million in total amount and a deal term of less than a year. They are used to support marketing campaigns, brand promotion, acceptance development, product innovation, or new technologies. Acquiring deals are agreements with rebates or incentives paid out of acquiring revenue margin. Acquiring deals should only be considered on an exception basis, as the priority is to incentivize issuers and not acquirers. The types of deals: the customer commitments, for example, volume and term, as well as the deal objectives, will determine the amount of rebates or incentives that can be afforded. Next, we will show you the types of incentives commonly used in constructing a deal. Generally, incentives fall into 3 categories: fixed, variable, and non-cash services. Fixed incentives are lump sum payments, which do not increase or decrease with volume. Fixed incentives are typically paid out as cash payments to customers and are subject to specific conditions or targets being met. Cash payments are typically structured to be paid based on 1. At time of customer signing the contract, such as exclusivity bonus and sign-on support. 2. An event occurring. For example, launch support is paid on launch of a product. 3. At various points of time over the contract duration, such as annual marketing contribution to support customers' promotion and/or to improve or maintain value proposition of the product. Fixed incentives can be paid upfront or paid in arrears and are generally subject to the customer achieving specific conditions or targets, failing which there will be consequences, such as clawback or contract extension. For example, exclusivity bonus is generally paid at the beginning of a contract with the condition of maintaining MasterCard as the only card brand during the deal term. It is subject to clawback if customer breaches the commitment on exclusivity. Another example is sign-on support, which is typically paid on contract signing, with condition of minimum spend volume guaranteed over the life of the deal. It is subject to contract extension if the customer fails to achieve the minimum volume within the original deal term. Given fixed incentives tend not to be directly tied to volumes, it exposes MasterCard to a higher risk in the event of underperformance. Therefore, the fixed incentives in a deal should form a lower proportion of the total incentives. Variable incentives are payments linked to performance, so the payout will vary when volumes increase or decrease. Typically, these incentives are calculated based on a percentage share of the volumes or number of cards. Variable incentives can be structured as a flat rate across all years, different rates in different years, different rates for base volume versus new incremental volumes, different rates for domestic versus cross-border volumes, tier rates with lower rates at lower volumes, and higher rates at higher volumes. For example, a deal can be structured with lower basis point support on domestic volume and higher basis point support on cross-border volume. This is because cross-border volume comes at a higher margin. Thus, MasterCard will be able to offer higher basis point support. Another example is card support, whereby per-card incentives are provided on every new MasterCard branded card acquired by the issuer, or on every competitor network scheme card flipped to MasterCard. Given variable incentives are directly associated with performance, there is generally less risk exposure in the event that the customer does not achieve stated volume or card targets. Non-cash services are one of MasterCard's key differentiators against the competition. Services consist of value-added advisory and consultancy provided by in-house consultants. It covers market insights, technical know-how advice, specialized tools deployment, and best practices sharing. The value of services provided to the customers can be denominated as a fixed amount or variable percentage based on volume, and is delivered in man-hours required for the specific engagement based on its scope of work. An ideal incentive structure should include a minimum level of fixed incentives, a maximum level of variable incentives, and a meaningful level of services. Remember caps when structuring deal incentives. C. Contagion effect. Benchmark other deals with the same customer or deals with other similar customers to ensure there is no contagion effect as a result of the amount and types of incentives provided. A. Avoid double dipping or paying multiple parties. For example, paying issuers and merchants on the same volumes. Also, avoid upfront cash payments where possible. P. Protection in the deal, such as clawback clauses. S. Simplicity. Avoid complicated deal terms and complex incentive structures that require significant administrative effort at the back end. Once the deal proposal has been structured, it must be submitted for internal approval. All applicable approvals must be in place in accordance with the policy before offers are presented to customers. Let's take a look at the end-to-end internal approval process. All deals are required to be documented in Salesforce or SFDC from start to end. Deals result from opportunities identified with customers. Once an opportunity has been created in Salesforce and has progressed through both the plan and engage and the identify need phases, primarily to define the terms and scope, a deal can be created. At this time, the status of the opportunity is develop and propose. To create a deal, the financials of the opportunity will need to be sized. All financials are to be calculated using the standard deal model. Some standard data points are required for every model. For optimal efficiency, it is recommended that these data points are sourced and validated prior to beginning the modeling process. When the standard deal model is completed, it must be uploaded into Salesforce together with the full detailed business case write-up. When the business case is completed, it will go through the deal review process, which will include both financial and non-financial aspects, such as deal strategy, product plan, and competitive positioning, in addition to other facets of the deal. In general, the level of internal approvals required on the total incentive amount expected to be paid over the deal term. The approvals required range from deal management team to RFO to AP Regional Deal Committee to IMK CFO or CEO, and finally to corporate CFO or CEO. Approval threshold matrix can be found in the Customer Incentive Agreements Deal Policy, published in the Hub. The approval matrix may change from time to time. It is recommended that the approval requirements are confirmed at the start of deal review in order to plan appropriately for approval turnaround time. It is important to consider all aspects of a deal. As a result, there are circumstances where additional RFO or CFO approvals are required, regardless of incentive amounts. Refer to Customer Incentive Agreements Deal Policy, published in the Hub, for details on special approval requirements. Salesforce is the deal system of record. All financials and the related terms and conditions must be documented in Salesforce for consideration. The deal is fully approved only when all required approvers sign off in Salesforce. Verbal or email approvals, for example, are not official approvals. When deal approvals are completed, the proposal can, and only then, be presented to the customer for negotiation. If at any time during the negotiation there are material changes to the approved financials and/or other aspects of the deal, then reapproval may need to be sought. Please refer to Customer Incentive Agreements Deal Policy, published in the Hub, for deal variance handling. When the negotiation is completed and the deal is won, it will proceed to the contracting stage, where the business agreement is drafted for signing. Legal will provide guidance on the contracting details. Deal management finance will be involved to support drafting of the financial clauses. Only after the contract is signed off by both deal management finance and legal, it can be signed by MasterCard and the customer. Duly signed contracts are uploaded to contract management within Salesforce by the account relationship manager and shared with Controlship and other internal MasterCard teams for implementation. Lastly, Salesforce needs to be updated with final deal terms and the final version of standard deal model, which reflects the negotiated deal and executed contracts. We hope this module has given you the understanding of the various types of deals and how they are structured, as well as the different incentive types and the internal approval process. You should now be well equipped and ready to structure a winning deal. If you have further questions on this topic, please contact the Asia Pacific Deal Management team. Thank you.